this next video lecture is about our methods of costing materials. So we are still in module number 7 for accounting for materials cost. So the important methods followed in pricing of the issue of materials are the following. Okay, so first is the actual cost method. Basically here, materials are purchased specifically for a specific job. Therefore, the actual cost of materials will be charged to the job. So such materials will normally be stored separately and will be used only to that particular job. So specific items of inventory was purchased to a specific job or job order. Meaning it will not, or these items will not be used in any other types of production. Okay, this will solely be used for producing a specific type of item. So therefore, actual cost should be used. The next method that can be followed is FIFO method. Okay, so we have here the definition from CIMA. When we say FIFO, I know that you are already familiar with this. So this is a method of pricing the issue of materials using the purchase price of the oldest unit or the first item that was purchased in our stock. So under this method, materials are issued out of stock in the order in which they were first received. Okay, it is assumed that the first material to come in the store should also be the first material to be issued for production and used. Okay, so we have here an illustration. So you are familiar with this already. Okay, so we have here the transactions, beginning balance of 800 units, received 200 units for 7 per unit, received another 200, issued 800 units, received another 400 units, issued 500 units in production. There was a return, okay, for the excess of 100 units and received another 600 units. So to account for that, so we have here the format, okay, to use to account for the FIFO method costing. So we have here the columns for the date, for the units, cost per unit, total cost, and the running total. Okay, so the first items here were our inventory, beginning and those which were received, okay, with their corresponding unit cost. So we have here the total. Okay, and then on February 11 we have the issuance. Okay, so first in first out basis, so we will get it from the beginning items. So this is our deductions right here from the balances. Okay, and so on until we get the ending inventory. So we have this in our previous module. Okay, so as if you could still remember. So this is just to show on how to account for FIFO method costing. Next, for the LIFO method. Okay, so this is the opposite of our FIFO method. So under this, most recent purchase will be first to issue. The issues are priced out at the most recent batch received and continue to be charged until the new batch received is arrived into the stock. So this is a method of pricing the issue of material using the purchase price of the latest unit, meaning what was received last should be issued first. Okay. So this is using the same information in FIFO method. So this is just the opposite. Okay, so for example, our issuance right here of 800, so we get it from the last items received. So this one should be issued first, followed by this earliest on February 4, and the last will be taken from the oldest. Okay, so that's why this is our record right here. Okay, and so on until we get the ending balance of the inventory. Next is highest in first out or HIFO method. So this was not presented before. So under this method, the materials with highest price should be issued first, irrespective of the date upon which they were purchased. So the basic assumption is that in fluctuating and inflationary market, the cost of material are quickly absorbed into the product cost. This is to hedge against the risk of inflation. So therefore, this method is used when the material is in short supply and in execution of cost plus contracts. So this method is not popular and not acceptable under our accounting standard. Okay, so that's why this is not commonly used. Okay, but I don't know if they or other entity uses it. So the purpose of this is to hedge, meaning to protect the entity against the risk of inflation. So they will absorb the cost of materials into production so that they will sold it at the high selling price at the moment, okay, to hedge against risk of inflation. But again, this is not acceptable in our accounting practices. Number 5, simple average cost method. So under this method, all materials received are merged into existing stock of materials and their identity being lost because they will be averaged. So the simple average price is calculated without any regard to the quantities involved. So simple average cost is arrived at by we will add the different prices paid during the period for the batches purchased and then divide it by the number of batches. So for example, there are 3 batches of materials received at 10, 12, and 14 per unit respectively. So to use or to calculate using simple average price, so we will just add this and divide it by 3 batches. So meaning the unit cost will be 12 per unit. Okay, so this method is not popular also because it takes into consideration the prices of different batches but not the quantities purchased in different batch. So this method is used only when prices do not fluctuate very much, okay, and the stock values are small and in value. Weighted average cost. So this is a perpetual weighted average system where the issue price is recalculated every time each receipt was taken into consideration, both in total and cost, while calculating the weighted average of the price. So we have this also before. Okay, for example, 3 batches of materials received in quantities of 1,000 units at 15, 1,3 at 16, and 800 at 14. So to calculate the weighted average price, so we will just multiply the number of units with its corresponding unit cost and then add all of them and then divide by the total units, okay, in the batch. So this is, or the result of this is, in our illustration or example, our unit cost using average or weighted average is 15.16 per unit. So this method tends to smooth out the fluctuation in the price and reduce the number of calculations, okay? Because each issue is charged at the same price until a fresh batch will be received. So this method is easier as compared to FIFO and LIFO. There is no necessity to identify each batch separately. But this method increases the clerical work because we have to recalculate new average price every time there is a new batch that is received. That is the only setback. So the issue price calculated rarely represents the actual purchase price. So we will have a new unit cost every time a new batch will be received. 7th is periodic average cost method. So under this method, instead of recalculating the simple or weighted average cost every time there is a new batch received, an average for the accounting period as a whole will be computed. So this we have also this in our previous module. The average price for all the materials issued during the period is computed as follows. So we will add cost of opening stock with the total cost of the receipts during the period divided by the units in opening stock, okay, plus the total units received during the period. Number 8 is standard cost method. So under this method, material issues are priced at a predetermined standard issue price. So any difference between actual price and standard price is written off in our profit or loss account. So the standard cost is a predetermined cost, meaning the entity was already, or they already identified cost, unit cost to be used. Okay, this is usually set by the management prior to the actual material cost being known. And the standard issue price is used for all issues to production and for valuation as well of our ending inventory. If initially the standard price is set carefully, then it will reduce all the clerical work and errors. and the stock recording procedures will be simplified. The realistic production cost comparisons can be made easier because it will eliminate fluctuations in cost due to material price differences. In a situation of fluctuating prices, this method is not suitable. So for number 9, replacement cost method. So this method is called a market price method. The replacement cost, this is a cost at which material identical to the can be replaced by purchasing at the date of pricing materials, meaning as distinct from the actual cost price at the date of purchase. So the replacement price is the price of replacing the material at the time of issue of materials or on the date of valuation of closing stock, meaning in this case, for example, the materials was purchased in a later date, and then the issuance of in the earlier date, and then it will be issued later on. So the unit cost that will be used is what is the unit cost of that at the time of the issuance and not at the time of its purchase. Okay, so this method is not acceptable for our standard since it reflects a cost which has not really been paid. Okay, because we are using historical cost. So if stocks are held at replacement cost for balance sheet purposes when they have been bought at a lower price, an element of profit which has not yet been realized will be built into profit and loss account. So this is the reason why this method is not acceptable. Okay, so this method also is advocated by charging the market price of material to the job or process, and it will make it easier to determine the profitability. However, it will have a problem later on in determining the profit or loss. Okay, this method is suitable particularly in the inflationary tendency of market prices of materials, where there is no precise market for a particular material. It would be difficult in ascertaining the replacement prices for the materials issues. Okay, number 10, next in, first out. Okay, or LIFO method. This method is a variant of replacement cost method. Under this method, the price quoted on the latest purchase order or contract is issued for all issue until a new order is placed. And I think next in, first out. Okay, it's like the replacement method, but it also resembles the last in, first out at the same time. Okay. Number 11 is base stock method. So under this method, a specified quantity of material is always held in stock and is priced at its original cost as a buffer or base stock. And any issue of materials above this base stock quantity is priced under any one of the methods discussed above. So this method indicates how prices are moving over a long period of time. But this method, again, is not popular and also is not acceptable under the accounting practice because we will disregard the historical cost, which was actually the actual cost of purchasing the materials. And this will result into a valuation which is totally unrealistic. Okay, so those are the different methods of costing our materials.